Bill Stone is the Chief Investment Officer at Avalon Investment Advisory. Bill, great to see you again. Let's talk this morning. Is this trade situation really the only thing that matters to the global economy? Because it looks like some of the data has been suggesting it could bottom without a big trade deal.
Yeah, I mean, I think so. To keep in mind, we are kind of anniversarying some of the, the start of, frankly, the tariff war. So I think a lot of this bounce is really the restocking that has finally come about since we've gotten through a lot of it. So it's not just the trade war. I think we actually can work through I'll say just fine without necessarily ending it. Obviously, it would be a positive to end that. And we're getting the headlines today that maybe that's pushed out a little bit more. But I always take those things with a grain of salt. That is also a negotiation still going on. So you have to be careful not to get too crazy with the headlines.
Right. So look, if we get this December 15th tariff that goes through, to me that makes sense. There's a lot of consumer stuff in there. Ahead of the holidays, it has potential to really kind of chill that consumer if they are aware of it, which I think everybody is. So that seems like a different conversation that maybe is worth getting upset about. But as they stand right now, do we have compelling reason to believe that the economy can't turn up even with the existing tariffs?
No, I think you're right. I think it's a different thing if we actually ramp up the tariffs. It's different. Right now, I think you're in a place, if you look at the PMI data, you're seeing a turn really across the globe. So, the US, Eurozone, Japan. Eurozone and Japan are still below that magic kind of 50 line, but the numbers they have turned up. So I think when you're kind of looking at the globe, I think there's a good chance that the evidence points that we've kind of bottomed out on the global growth. As I mentioned, I think it's that restocking has finally come in. We got inventories down enough that you're seeing a bit of that turn. Now, again, people talk about the ISM came in a little weaker yesterday. The key with it is really ISM measures. Partly the US ISM also picks up some global data. The market version, which is what you're seeing, that is up above the 50 line and turned up, it is really they asked them to focus only on their US business. So there's no doubt that the globe is weaker than the US, but it looks like we're getting the turn.
Now, I love this chart. This is after yesterday, there's a few data points you're missing, but I think what's important is the overall trend, and the idea that the ISM picks up some of that global weakness makes sense, because even though those numbers are improving, right? Take Germany, for example. We had a nice beat for expectations, still sub 50, and a lot of these other numbers, Japan in particular, has kind of been the laggard.
Yeah, exactly. I mean, and even China just barely edging over 50 now, but has been below 50 for quite a while here. So you're exactly right. I think it bled into the US ISM numbers, but if you just try and get down to our US, and obviously the globe matters, but the US really is the big dog in terms of thinking about the economic growth side.
So what does this mean from an investment standpoint, Bill? I mean, can one feel confident having positions in risk assets with this back and forth still happening based on the economic data? Or can you not sort of fight whatever the sentiment is and the sentiment impact that does move markets like they're doing today? I mean, is it just a short versus long-term perspective?
I think so. I think you have to focus, and particularly in this environment of daily news headlines going across, where you think things are going in the longer run. And at least we're investors, so I'm not trying to trade every day. So really think about where you think the things are going. And I do think kind of to that chart that things are getting better. So if you've actually got less of a chance of, say, a recession hitting, usually big drawdowns in the market, I'll say over 20%. Are typically associated with recessions. If that's not in the cards in the foreseeable future here, I think you can feel a bit better. Doesn't mean you don't have sell-offs, clearly. You can't, no guarantees on that, of course, but you can feel a bit better about the downside risks, I think.
Bill, are we at the point where the rotation that we've seen in this market, right? We've had this really interesting shift, momentum to value since September, that's gone hand in hand with a more risk on, but a specific type of risk where it's helping banks, it's helping industrials. We've had yields helping regional banks. So now you've got this market that's bifurcated. What I'm trying to figure out is, if the economic bounce continues, can you have faith that those types of cyclical trades will work? And then if it doesn't, I mean, do we run back to the momentum and growth stuff, or does that still have too much kind of froth built in? I mean, is there a little bit of a catch-22 here for equities where either the bounce in the economy happens and that's good for cyclical stocks, or if it doesn't, then maybe just steer clear overall?
Yeah, I think in terms of the rotation, we've kind of said I don't have the guts to because I just don't think there's enough evidence to say you should go fully all in value versus say the momentum or the growth trade. I think, think about keeping yourself kind of even there, whereas before probably should have been tilted. I mean, obviously it's always easy in retrospect toward the growth side of the equation, growth momentum. I don't want to be completely out of there because it is too much of a hard call. I think you just make sure, perhaps because growth has been so good for the past 10 years, you're probably overweight growth, so maybe bring those down to even. I think the place where I have a little bit easier place to say, hey, I think you really should think about taking some profits in is, say, the really low volatility trade, because that has lived off of lower interest rates and other things and real worries about the economy. That to me is those stocks are extremely expensive. Momentum, eventually moves around to what's, it's what's working over time. So I'm less concerned about that over the long run. I think I'd be a little more leery on that, that low vol trade.
I like this point. To me, that sounds like real estate. It sounds like utilities and some of the other bond proxy type stocks. Bill, there's been, I call it this like whisper Fed put in the market, where in the month of November, we had strength in bonds again that came around some of the FOMC and the Jay Powell commentary. Even though he's been saying he's not going to cut anymore, I guess there was this kind of thought that either the repo action or the idea he's not going to hike without inflation was putting a bid back into bonds. It seems like maybe what you're telling me is that doesn't really kind of vibe with the idea of the low vol trade as running its course.
Yeah, I mean, I think in the sense, I think it's still, I don't think necessarily yields are going down much. Certainly with at least what I think about the economy, right? You should see some movement. I don't expect them to go up a ton by any means, so I'm not necessarily scared of that side. I think that's actually a benefit for the market because I don't see the yields going crazy. But yeah, I don't see it going down and feeding. Like you said, I'll just say pick on the utilities, some sort of really massive rally in the utilities because they essentially become a super long duration bond, right? And so I think that makes sense that that's probably not going to be a help to you.
Yeah, all right, Bill, a really good perspective. Great to have you on the program. Appreciate it. Bill Stone.
Thank you.
Thank you, sir. He's the Chief Investment Officer at Avalon Investment Advisory, looking to take some profits in the low vol bond proxies. We'll keep an eye on it as we have been.